Here we go on the S&P 500. Today's date is 9:14 a.m. Pacific Standard Time, 9:29. What do we have ahead of us tomorrow? We're going to talk about the government shutdown and what kind of role that would play in the S&P 500 index. You can clearly see that from the last corrections that we've had, and we've updated this a week ago on the website. Here we talked about a week ago, when you take a look at the S&P 500 chart analysis from last Sunday that we talked about how that bull rally had to have a pullback. The analysis is here. The all-time bull high after the last correction is that if you take a look, 1, 2, 3, 4, 5 down days, you had one up day, so you had five down days out of 6, and you close flat right back here at the bottom. You're below the 10-day simple moving average. Now, how does the government shutdown work? Well, Wall Street will discount it because they feel their consensus is only for a few days shut down, and that wouldn't be the problem. But what is the real problem is the debt ceiling. Now, let's talk about how it affects the GDP. Last time in 1995 and 96 when this happened, but our world and our economics today are quite different than it was at that period. So when you're looking back historically, you got to be able to weed out some of the differences now, where the real world is today and where the world was then. Now, you could lose close to a point and a half of GDP in Q4 if the government was to stay, let's say it stayed shut down for 21 days. They're going to try to pay the U.S. Armed Forces and some of the other things that keep, our services moving, and people need to be paid. The Obamacare is the culprit. They're not negotiating on it, and they have until tomorrow night to come up with a resolution. Now, in the past, the way that government has played their roles is back in 2012, we went through something kind of similar about their debates and about this is going to happen. And down in the 11th hour, they came through, and off to the rally we went, and we got a great big bull run move in calendar 2013. We're going in to a quarterly earnings that's coming up starting on October 8th. You got the debt ceiling in October. It'll be after the first calendar week. It'll start the second calendar week. That's the real problem. The shutting the government down, we know that once they do shut it down, and markets are looking for a reason to sell off. So we talked about the S&P at around 1675, where it has a great support level, 1680s. But the real support level is 100-day simple moving average on a daily. So what we'll be looking for throughout the havoc, or the storm, the government storm is what we refer to this as, is where do stocks get from an overbought level that we talked about that have to come down. And when they do come down, that money is on the sideline. The big bulls, the people like Warren Buffett and Icon, just two to mention, not to mention there are many others out there, feel that the markets are not compelling to buy up here. They were in 2009. We're deep in the expansion cycle, but how does this short-term volatility, we're at record level complacency, meaning that there are very few people on the put side of the market. That's when markets fall. The majority of the percentages are that the bulls are up toward their highs, continue to stay in their exuberance. But let me just tell you, just like we said over here, you had to come down. That was the buying opportunity. We said it back in August. It's on the website. You had to come down. Once it hit that support level and it wouldn't break, we rallied up, made an all-time high. We're going into the end of the calendar year. We got a very soft earnings cycle coming before us. There's lots of volatility. Markets aren't on sale at 1691 on the S&P. That support level at the 100-day moving average will remain at 1660. At that point, if we hold that support level, of course, we're going to look at buying the calls in the S&P 500 to rally back up and challenge these highs again, or maybe even break these highs. It is possible. Once the government shutdown happens and once it gets out of the ways, that would create a buying opportunity. We will be doing the following. We will pick them off during the earnings season. The good quality leaders that have lasted throughout the calendar 2013 with the soft quarter that's coming upon us in the earnings season is that there would be a time to buy those dips much lower than what they currently are and make great moves from there to the long side of the market. Now, these support levels right here, that's the 50-day simple moving average at 1680. If we break it and undercut it, that's the main support level right here in the shorter term. But each one of these support levels are higher than the previous support levels, which is very good for the bulls because we're going to find out that this sell-off that we called for back in May, that was a great one right here. And we called it 1560 with another high. We are higher here on the pullback, which created a buying opportunity, and they went screaming higher. Made another 13-year highs in a lot of these indexes. So once again, stocks are not on sale. They can be bought cheaper than what they are today. And you know, when you look at them on an individual level, you look at where they're overbought and the oversold conditions are, is the best time with the least amount of risk is to buy when they pull back and they're oversold in the pullback. That's the time to get net long, because it is. So this upcoming week, starting on 9/30, which is the last single day of the quarter, tomorrow's Monday, and they have until Monday night. Now, one of the things that they've been doing in the high frequency model is taking bad news and running markets higher. That's also a possibility that they can actually shut the government down. You would bounce in the futures market because they would buy the futures, the opposite of what people would be expecting. You would hit resistance levels in that scenario and then reverse and come down. These indexes need to come down. Now, if we only stop here at 1660, that means that this high is higher than this high here was higher. So we got a series of the highs. These lows are much higher than the previous ones, is what I'm saying. And this one would be too, slightly. So the volatility is going to pick up. We feel that the government shutdown is going to happen. We've been saying that all along. That would create the selling volatility to buy equities that are on sale. Now, just be advised, MMTs, that the call to put ratio is showing a very big complacency. The minority side of the trade is the put side. That's when things fall. So people are, how do you tell that they're complacent is that they're not buying a lot of protection. They're not. So when you're not buying a lot of protection with a potential good sized pullback, that is complacency. And that's when markets get bigger pullbacks. And they have to adjust themselves, and that's what's going to happen on the S&P 500. So we're going to call this the government shutdown and debt ceiling trade, as it will be. Then we get into the core part of the October 8th earnings starting, and we go through the calendar month of October and part of November to get the quarter out of the way. What we would say is that when markets are overbought, there is no Thanksgiving or Christmas rally when they're up here. But if we do come down low enough and set everything up, and then all the fears and uncertainty get out of the way, that's the perfect time as far as indexes go to get the calls. Because when I show the S&P 500, MMTs, listen here. This is a 1670 call right around in that pullback from the 1730 high in the S&P index that's in this video that you would come down. Here's what happens when they get super inflated. They had a great move down here at 1750 and they went straight up to $62. That is as big as money as you could want. Now when they got inflated, they pulled back here to $34. They've almost been cut in half. If we pull back and continue to pull back and these contracts can get down here, let's say to the 2250 area, and we land at support in the SPX, that's a perfect time to start buying the S&P 500 index calls because there would be a good relief rally and a great trade at that area, at that level. So here's what happens. There's great trades that can happen. We think that once the markets sell off and the uncertainty gets out of the way and these get at a wholesale price level, this is exactly where we're going to make a lot of money, is on that call side, that bull side. Now back to the SPX.X. Here it is right here. 1660 would bring us right down below the 1670 call area, where we would take a look, and of course we're going to be looking at what? We're really going to be looking at the November strike price for the longer haul. But we have to be very mindful that the earnings season is going to be weak. So there is two trades to this series. One is when we hit the first support level from a 1 to 3 day to a 5 day potentially. Now it's going to go from 1 day to 3. We would buy the calls. We would make a great gain. We would exit. Why? Because when we get into the earnings season and we start getting into the S&P Cash 500 earnings, that's all 500 stocks combined, is what that multiple is that we could find ourselves going lower short term before we really get that year-end rally. So there are a couple of components. One is the government. The other one is the earnings season. We have to separate the two, and the trade management has to be separated in two parts. Once again, looking lower where a buying opportunity would happen at the 100-day simple moving average on the SPX. Using the monthly chart, we can see where the highs were up here at 1730. We can see down here that the 10-day monthly moving average is at 1585. But when we look at the 10-week moving average, that's going to come down and test that 1680, slightly below where we closed. There's the September rally that normally never happens. September is historically a month where markets never do well, but in the high-frequency model, they wound that tape up. Now, October could be the washout month. We've got everything from being overbought to getting down. There is the 1660 handle at the 20-week simple moving average within the volatility S&P 500. Once again, the index calls, that's the option chain that we're going to show people. That's right here. We will be looking at the November regular for the longer term haul, but we would take the shorter time frame of where the 1670 call would get on sale, and we could get 20 contracts wholesale, make a $10, make $20,000, bail out of the trade, of course, because in the earnings season, in the S&P 500 gets fully in bloom, and we would automatically move to the November contracts in the S&P 500. So once again, I can show right here what a November 1660 looks like, but we're going to be very short term in the trading. The longer haul would be that, depending on where we're at, these were $77.50. They're down to $49. It would be great for the market to pull back, and they get clear back down here at $30. Okay. Parabolically, the index calls, you can make a fortune at $30 a contract. They went up to $77.50. This is a monthly now, and it's a November regular 1660 call in the S&P.